There were very few investors who realized the world was heading into financial turmoil. My guest on Hard Talk today saw what was coming and made a fortune from it. First from America's subprime mortgage crisis, and then from betting that Greece would default. He reckons next it will be France and Japan whose economies collapse. But is the behavior of speculators like him partly to blame for the mess the markets are in? Kyle Bass, welcome to Hard Talk.
Thank you.
What was it that made you realize back in 2006 that we were heading for a crisis?
Well, the 2006 scenario was mostly a U.S. phenomenon. And if you took 3 steps back and looked at the housing scenario, I think everyone in the U.S. realized that we had this enormous housing bubble. And if you think back to what Alan Greenspan, our Fed chairman, did in 2001, as our dot-com bust was really going into full motion at the back end of 2000, Greenspan basically traded the dot-com bust for the housing boom. He lowered rates to 1%, and housing in the U.S. on a nationwide basis had never gone down in value, and he thought that that was the way to come out of the dot-com bust aggressively. So, when Greenspan traded the dot-com bust for the housing boom and then he quit and handed the reins to Bernanke, what we started looking at back then was, if you think about it, you have median incomes in the U.S. and median home prices. And those 2 lines had moved in pure parallel for the better part of 50 years. And it just makes sense logically. For every increase in median income, you had a commensurate increase in median home value because the affordability scale stayed in check. When Greenspan started, trading the dot-com bust for the housing boom, you saw a massive divergence. And the divergence between median income and median home price got to be over 8 standard deviations wide. So home prices took off while median income stayed relatively stable.
Okay, so you recognize that this is a market that's overheating, but I know you described it as the fat pitch, the once-in-a-lifetime, low-risk, incredibly high-reward scenario where we're going to be right. You sort of saw it as something that you could make huge sums of money on.
Yeah, you know what? I know that sells a lot of books and television when you talk about nefarious speculators taking the fat pitch and speculating, making a lot of money. I think it's really important to understand that when you're a fiduciary, like I am, and people invest their capital with me, number 1, to not lose money, and number 2, to make great risk-adjusted returns. We had a portfolio of global investments at that point in time in 2006. We owned equities all over the world. We owned debt all over the world. And you know what? This hedge, to bet against the bottom 3% of a subprime securitization, and it only cost me 1% a year to put that hedge on, I thought it was the best asymmetric hedge I'd ever seen in my life. And so when you look at our fund, we were very long in the fund. We owned securities all over the world, and this was our hedge, just in case something went wrong. We came to the conclusion that it was likely something was going to go wrong, and the good news is we had a very asymmetric hedge position on. And that's very similar to what we're talking about today with the sovereign crisis. We have a large portfolio of investments all over the world, and we have enormous hedges in Europe and Japan.
And we will try to explain why you have that in a few minutes. But just to go through the history in ways that people can understand, you saw the problem in housing, and then you realized that it was going to move. It was going to move to the banks, and then it was going to move to governments, because that was, and this was debt that was effectively building. And you did some maths, which other people hadn't done before, which was effectively work out just how big the debts were.
That's correct. So when, as the housing problem in the U.S. metastasized and it started to, again, move globally, what we started to see, as you remember, call it beginning of 2008 all the way into Q1, Q2 of 2009, is every time a highly levered institution, whether it be a bank or non-bank financial or even insurance company, got into trouble, whether it was in the US or Europe or elsewhere, or Iceland for that matter, what happened was the central governments decided to take those bad private assets or that private risk and move it onto the public balance sheet via guarantees or asset purchases. Well, we were deciding back in mid-2008, we were trying to understand whether the world was just going to go through this massive delevering and debt destruction at that point in time, or whether it was going to move onto the government's balance sheets. And every time you saw a bailout back in mid-2008, it was moving bad private assets to the government balance sheet. Well, back then we went searching around the world for a listing of what government balance sheets really look like with on-balance sheet debts, and then how big their banking systems were.
Okay.
And no one had done this work. And again, this what...
So that
was really important to understand.
Forgive me for interrupting, but so that people understand, I mean, you were literally looking at how big debts were and how big revenues were for different governments.
That's correct. And what really solidified our search was when Iceland got into trouble. Iceland has 300,000 people. They only have 20 billion US dollars at the time, 20 billion USD of GDP. And in 3 banks in Iceland, they had over $200 billion worth of assets. So when Iceland's banks went bad, it immediately sank the country. And at the height of what just went on, call it the last 3 or 4 years, there was no provincial regulator deciding that the enormity of a host banking system, or let's say no one was putting limits on the size of a country's banking system in relation to their government revenues, because it was generating such enormous GDP and jobs growth and things like that. So at the height of what just went wrong, no one was paying attention.
So, except you were, and you've since then taken positions against governments that economies would collapse. And I wonder, can you tell us, from the point in 2006 when you thought, look, this market's seriously overheated, let's put a relatively small amount in and take this bet. How much money have you made on that?
Yeah, you know, I won't discuss particular profitability at our firm. We did very well for our investors and for ourselves because we saw this coming. We had losses on one side of our portfolio. We had gains on the other. The gains exceeded the losses. I think that's likely to happen again soon. And what's more important is to talk about the global debt scenario and what's likely to happen going forward.
Okay, and we will do in a minute. But in order to understand it, I mean, people would be curious about how it works. And one of the things that you did was by using, in a way, and if we use, for example, the bets that you took against Greece defaulting, as I understand it, from what you've said in the past, for effectively a $1,000 bet, you could make $700,000 because of Greece defaulting. Is that right?
So that was in the initial stages. So back in 2008, when the world's sovereign debt problem wasn't on the radar of the press, whether it be the papers or the television, in the very beginning of this crisis, you know, Greece's, if you look back to beginning of 2008, call it mid-2007, Greece's sovereign debt traded as if it were German sovereign debt. And it traded within 11 to 17 basis points of one another. In theory, you could buy Germany's sovereign debt and you could short Greece's sovereign debt and only pay 11 to 15 basis points, or call it, you know, 11 to 15 1/100ths of 1%. To put these positions on. Those were great asymmetric hedges at the time. Today, the asymmetry is not really there, but back then it was.
So, but that is so, in terms of the amount of money, I appreciate you don't want to talk about profitability, but just so that people get their heads around what we're talking about here, on something like Greece, you're talking about, for a £1,000 investment, getting back 700,000. Is that order of magnitude?
That order of magnitude was possible back in mid-2008. It is not possible any longer. It's not even close.
But you effectively closed that position having made that much money on it.
So we didn't make a lot of, again, you have to realize that this was a hedge to our existing book. And so we constantly monitor our hedge and our hedge ratios. We currently don't maintain any positions in Greece because right now the asymmetry's been lost. I think all of the asymmetry in the world lies in Japan.
Okay. We'll come on to Japan in a moment, but before we leave Europe, you predicted Greece's, or at least the default and the problems that the economy was going to get into. Do you see Germany
Correct.
as effectively going to stand behind Greece and Italy? Is it going to resolve the problems within Europe?
The only way to, quote, resolve any problems in Europe is to have massive debt restructurings, is to have these write-downs. I mean, one of the things we say in our office recently, I don't know if this program is made to be humorous, but you know how screwed up Europe is when you have a German Pope and an Italian central banker. I think we have a scenario today in which debt, the very important thing to understand is debt has grown globally in the last 9 years from $80 trillion to $210 trillion. So global credit market debt has grown at 12% a year for the last 9 years, while global GDP has grown at 4%. So we're in a scenario where the pigs, right, you have Portugal, Italy, Ireland, Iceland, Spain, and Greece, all in a scenario where they've sailed into a zone of insolvency. And when you sail into the zone of insolvency, there is no, quote, solution for you. The only solution is to simply, the bill's due and you have to pay the bill. So what has to happen is it's of our opinion that these debts have to be written down. It's that simple.
But if you pool sovereignty, if Greece, if Europe, the Eurozone effectively becomes one country and Germany stands behind its southern neighbours, does that not resolve the problem because you have the earning power of Germany?
Oh gosh, no. Look, first of all, Germany has restructured its debts or defaulted twice in the last 100 years. Germany has 81% on-balance sheet sovereign debt to GDP today, and they haven't recapped their banks yet. Only the UK and the US have recapped their banks. The rest of Europe hasn't recapped anything. Europe's banks are 3 times as levered as the US's banks today. So if Germany, think about what you just asked me. Basically, you're saying if Germany goes joint and severally liable with the profligate idiots of Southern Europe, will that, quote, solve the scenario? Think about this. Let's assume Germany goes to doing a Eurobond, and Germany takes on these. First of all, the German Constitutional Court has already ruled that that's illegal in Germany. But let's assume that they get over that, and they go ahead and issue this bond. Well, what would that do for the profligate members, including Greece, when Greece says, okay, we're all in, we're good, you're lending us more money, we have a big debt problem and you're lending us some more, now we can borrow a little cheaper. And then Greece keeps spending. And they go back to Germany and say, okay, Germany, I need some more money. And Germany says, no, we're going to impose this real austerity on you now. And Greece says, well, it's fine, we'll default. Every single time from now on, Germany is in the exact situation it's in today. We call it in Texas, we call it a Mexican standoff, meaning there's no winner. The profligate members will always have Germany by the short hairs every single time this scenario comes up. So I disagree. I don't believe Germany will end up going all in. It would not be to the benefit of Germany to do so in the long run. And I mean, let me ask you this question. How many of your relatives...
Well, let me ask you about...
How many of your relatives would you go joint and severally liable with?
And that's the position you see Germany in, because Angela Merkel, the Chancellor, has said Germany has had only one goal, that is to bring about a stabilisation of the Eurozone in its current form, to make it more competitive, to consolidate budgets.
Yeah, so the European Union won't work unless it has a centralized taxing authority, and every member of the EMU 17 cedes its fiscal sovereignty to the EMU. I think that's a tall order. I have a goal of attaining world peace in the current situation, the way the world sits. Unfortunately, I can't get to those goals because there are so many mitigating factors that prohibit me from getting there. I mean, I understand what the rhetoric is, and if you were the politicians and the regulators running this scenario, you would be saying the same things in public. The bottom line, though, is the markets are already telling you that that's not going to work.
Okay. So what about Japan? Because you've already mentioned Japan, as you see, where you're the next place that is going to fall, and fall big time.
Yeah, I mean, if you just analyze Japan, there are a few things that are indisputable. Japan has the single worst on-balance sheet problem with sovereign debt in the world. That the facts are the facts. What's more important is, why did a scheme like Bernie Madoff in the United States, why did that fail? Bernie only needed one thing to keep that going: more people entering the scheme than exiting. The reason it failed is at one point in time, he had more people exiting than entering. In Japan, they're the most xenophobic society in the Western world. They have an inexorable population decline. They've lost about 3.5 million people in the last 4 years. They are going to lose some 27 million people in the next 40 years to their population demography. They have the worst demographics of any nation in the world.
Okay, but they also have
bonds.
But they have households sitting on savings apparently in the order of $15 trillion. They hold more than $1 trillion in currency reserves, second only to China. They've got those public who you describe as xenophobic, like their own government's bonds. And there are signs in the recent times of growth and the economy being strong.
Okay, so let's analyze everything that you just said. First of all, they're personal. So the private assets of the public are more close. They're very close to 13.2 trillion and not 15. This is the first time in history that the country's sovereign debts have exceeded the private assets of the individuals. Number one. Number two, Japan has. When you look at their central government revenues and their interest expense, let's think back to Italy for 1 second. Italy was sacrosanct. They were a pillar of the European community as soon as 6 months ago. And then when Italy's 10-year rates went from 5% to 6%, they went from perfectly stable and fine to a full crisis in 100 basis points. When you look at Japan, Japan spends 50% of their central government tax revenue on debt service alone today, of which half is interest. If Japan's interest rates move at all, if they move 200 basis points, call it 2%, Japan's debt service will exceed their revenue.
Okay. Isn't there, given your history, because, you know, here you are sitting, you've made your name as somebody who's made an awful lot of money betting against governments. That's why you get invited onto a program like this. And you can say, look, I'm betting against France and Japan. Japan, it's going to go down the tubes, guys. Isn't there a danger of a self-fulfilling prophecy here, that you are going to encourage something that may be in your interest but isn't in a whole country's interest?
So, by the way, none of this is in my interest, right? This is all going to happen with me or without me. I am a prudent fiduciary. I manage the retirement monies of many companies and individuals in the United States, and for that matter, all over the world. People invest with me for one reason: to try to not lose money. And when I invest, I own things all over the world, and I hedge them with asymmetric positions. I know it's a great TV thing to say that this is someone that's profited at others' demise. In the mortgage marketplace, the only people I profited against were synthetic CDO managers. Again, the scenario would have played out with or without me. I played in the fantasy football market against a professional.
But you have the hedges that you're talking about use something called a CDS, a credit default swap. You take bets, you take out
only in Europe, not in Japan, only in Europe.
Okay, but let's take a look at what you did in Europe, because it's caused all sorts of problems, and as you know, politicians have got really worked up about it, and in various degrees have banned what is known as naked short selling and short selling, because basically you've taken out insurance on something you don't own. And if insurance is to protect an investor, why should somebody who doesn't own that underlying asset be allowed insurance on it?
That is a great question. So does Europe have listed options markets on all of their equities and equity indexes?
Well, you're losing...
They do, don't they?
Why are you asking the question?
No, well, because the listed options market allows you to buy options on stocks and indexes that you don't own, which has gone on for decades. And you're alluding to the fact that there's this nefarious marketplace in the debt marketplace that's something different than that of the equity marketplace. If you wanted to go buy a put option on Barclays Bank, and you don't own Barclays Bank, you can go do it. And you've been able to do that for 40-plus years?
Okay, but let's look at a different market.
Has that caused any problems
you can't buy insurance on somebody else's house. The whole point of insurance is a protection. And the reason people get exercised about it is that they believe that it's responsible for exacerbating market falls and for increasing volatility.
Yeah, let's go over that. You know, I hear your hostility on the other line, so it's very important to understand one thing. Let's look at Greece. Greece has $500 billion of on-balance sheet debt, right? 380 billion euros. If you go to the DTCC website and you understand the CDS marketplace, the net CDS position today in Greece is $7 billion. $500 billion of cash, $7 billion of CDS. And by the way, guess who owns more than half of the $7 billion? The Greek banks own it themselves. So when you saw Merkel and Sarkozy and you saw Lagarde back when she was the finance minister of France, if you remember on the very front end of this back in 2010, they were on a warpath about CDS. And then all of a sudden they stopped when they realized the majority of the people that own CDS are bona fide hedgers, banks in Greece owning Greek CDS.
Okay.
They
so
stopped talking about it.
When you were asked
basically what I have to say about that is you can't hate the mirror because you're ugly. All CDS is a barometer.
Okay.
Of the relative health of that marketplace.
Let's move on to what you said to your mother, because when your mother said, "Where should I put my money?" You're reported as saying into guns and gold. Why guns and gold?
I mean, as you know, it's a euphemism. I think if you have world governments, look at the U.S. Federal Reserve's balance sheet is now $3 trillion. We have created $3 trillion out of thin air. Pre-crisis, we only had $1.8 trillion of base money supply of M1. We only had about $1 trillion of equity in the U.S. banking system. We had about $14.5 trillion of assets, $1 trillion of equity. We now have created $3 trillion out of thin air. The ECB's balance sheet, $3 trillion as well via repo. So we've created, literally, between the U.S. and Europe, we've created $6 trillion out of thin air. Why on earth would you want to own paper currency today?
Okay, so again, which is why we've only got a few minutes. So I just want to explain. It's why you've bought gold bullion. It's why you have gold bars sitting in a vault.
Yeah, I mean, look, buying gold is just buying a put against the idiocy of the political cycle.
Okay, what about the other bit of the advice, guns? Is that because you fear social unrest as a result of what's going on?
Yeah, I think if you look through history and you understand through history when debt levels, aggregate debt levels in various countries globally get to levels, by the way, where we are today is the largest level of peacetime debt in world history. Typically, throughout history, countries would deficit spend going into wars to get debt levels to where they are today, and to the victor go the spoils, and to the loser goes defeat and default. The problem is today is if we're right about this global sovereign restructuring coming, what's likely to happen? It's likely to at least rupture the social fabric of the world, like you're seeing actually throughout the world today. I think it will be a more dangerous place for the next several years. It's not the end of the world. It just means it's going to be less socially cohesive.
You are reported as having bought a sort of very large fort in Texas and having an arsenal of weaponry there. Is that because you fear what could happen?
No, I mean, this is hyperbole. You know, I bought a share in a fort in Texas, and it's not a fort, it's a ranch. Everyone in Texas goes to ranches on the weekends. And, you know, I support the troops from both the U.S. and NATO when they get wounded. That is where I spend my philanthropic capital, giving to those that have risked their lives for both of our countries. And so these reports get all, in my opinion, get built on one another.
One other thing you have been quoted on is the suggestion that actually we're going through this because it's atonement for past profligacy.
It is. I mean, you have to realize capitalism without bankruptcy is like Christianity without hell. Right? You have to have atonement for the ridiculous levels of spending that both the U.S. and Europe have gone through. I mean, when you run 10% fiscal deficits, that doesn't sound so bad, 10%. But when your government revenues are 16% of GDP, right, you're almost spending twice what you make. So the spending idiocy of the world is going to catch up to itself, and that's where we are today.
Kyle Bass, thank you very much.